for kind of what, really kind of what kind of audience I've got. So, this is an important poll. I'd like everybody to please vote. Kind of give me what your thoughts are. Gives me a real good feeling about what kind of audience I've got. So, wow. Wow, a lot of people are real happy I don't live in their house so far. Very few people. All right, we'll give this poll another minute, then we'll be on our way. So, who's going to be disappointed is my wife. That her answer, unfortunately, she doesn't get a chance to answer that last one. So she's kind of forced with the other four. So I voted to have. I ran a poll about what's the best thing about me, and 86% of people have all said he doesn't live in my house. Honestly, I'm kind of excited. 7% think I'm super smart, and I'm assuming 7% voted I'm humble as kind of a joke. So, oh, handsome. Well, thank you. All right. Well, obviously, you can tell this is a joke. I just like to have a little bit of fun when I'm done. I'm going to close the poll. My name is welcome to Option Pit. This is trading direction using volatility to improve directional trading. And I am Mark Sebastian. This is me in New York about a couple months back when I was talking about using stop orders. I actually was just back in studio last Friday talking about trading short squeezes. Couple of things that were kind of interesting. Liz Clayman, actually, I think she was wearing the same dress. I don't know, but she might have been. Yeah, she was wearing. She looks about my height. Now I'm not tall. I'm about almost 5'9", but her heels were probably 6 inches tall. And David Asman, I was surprised that he was not that much taller than me, but she was super nice, super friendly. All right. So now let's talk about directional trading. All right. Volatility can act like a headwind or a tailwind to successful trading. Actually, when I was flying out to New York, my trip to New York was about 20 minutes faster than my trip back. Why? Well, because on my way out there, you're flying with the jet stream, you have a nice tailwind, and on my way back, I'm running right into the jet stream, and it slows down the plane. So by using volatility, it can help us with basic buy-sell decisions to profit from directional trading. It can help us discover how strike selection can make the difference between a good trade and a bad trade. And then the combination of buy versus sell and strike decisions, you can really pay off. Like if you can pick the right, whether to buy or sell, and then the right strike, you basically have directional trading down if you're good at picking what direction the stock's going to go. One of the things that throws people off is that unlike something like futures, with options, you can be wrong and still win, and you can be right and still lose, which is one of the most frustrating things in the world. And I'll show you a prime example of that here in a little bit. Options in stock. All right, so the key to trading options for direction is the word correlation. All right, correlation means how one instrument moves with another instrument. All right, in the terms of something like the SPY, that correlates to the S&P 500 at almost 100%, or almost 1. All right, correlation of 1 means that the two instruments move perfectly with each other. All right, a correlation of -1 means the two instruments move perfectly opposite of each other. All right. In the case of an options contract can never have a correlation greater than 1 or less than 1. Different stocks can have correlations way over or way under negative, 1 and negative 1. All right. If you look at GoPro, its beta to the S&P 500 is something crazy, right? You look at something like, the UVXY, its negative correlation is way over 1, negative 1. So, all right, now, delta. All right, we're going to talk about the term delta. Delta is the option trader term for correlation. You want to know why we use the term delta? Now, there are lots of reasons. My theory is, 400 guys standing around talking about trading have better things to do than to say correlation over and over and over again, and they decided to move to a two-syllable word over a correlation, over a four-syllable word. So I think it was just all about syllables. That's my theory. I don't know. What do you think? Yeah, thank you. All right. So delta and correlation can change with the passage of time. They can change with underlying price. And one really important factor that we're going to really hit on, and I think you already know what it is, but I'm going to talk about it in detail. All right. So delta can be described in many ways, but its most commonly used is correlation. All right. Thus, an option with a positive 0.6 delta will make 60 cents for every dollar the underlying rallies. All right. It will lose 60 cents for every dollar the underlying falls. All right. What makes delta so hard is that it can change on you. All right. So I think price movement is pretty easy to understand. Passage of time is somewhat easier to understand. If I spend a little time on it, I can pretty much get someone to figure out passage of time. All right. But the one that can really have the greatest effect on performance of a directional trade is volatility. Hands down. Not even close. All right. Has this happened to you? Mark, all right, the funny thing is, so I do this voice, and it's my best imitation of the voice that my brothers and sisters and wife make of me when they think that I am talking about something I don't know what I'm talking about. Okay? Like my wife will go, "Oh yeah, is that what they do in aeronautics? Yeah, is that how airplanes work?" So, Mark, market makers are cheaters. I bought all these calls right before earnings. The stock is way higher, but I'm not making money. Market makers are taking my money. All right? So that is the voice that my wife would make if I was talking about something I didn't know what I was talking about. All right? Now, the fact of the matter is, no one is taking your money. All right? As I'm sorry to say, but it's just not the case. All right? What happened to you is delta changed because volatility changed. All right? Volatility is based on, perceived forward movement, and that changed. All right? And that is what happened. All right? And, I'll give you a prime example here. All right, of how delta can change. All right, and we're going to look at a little fruit company called Apple. All right, and Apple maybe had a little bit of an announcement today. I don't know if you guys knew, but Apple had an announcement today. I don't know if you guys knew that. All right, now let's take a look at the September regular call options. All right, now I want you to take a look at a price chart here. All right, I'm going to do this. I'll expand out. All right, and this is what Apple options looked like yesterday in September. All right, and let's say you said to yourself, you know what? I think all this Apple hype is a load of ginormous hooey. All right. I think it's a bunch of Apple fanboys that, need to spend a little less time worrying about an iWatch and a little more time worrying about getting a date. All right. Let's say that you said that yesterday. All right. So you say, you know what I'm going to do because I know Apple's going to drop. All right. I'm going to buy the September 97.5 puts. All right. Because Apple's going lower tomorrow. All right. I think Apple's going to be lower. So you say, you know what, I'm smarter than the average guy. I know Apple stinks, and I'm going to buy the September 97.5 put, and I'm going to pay $2.15. All right. Well, now today the announcement comes out. All right. The big Apple announcement comes out. And you look at the Apple's stock price at the end of the day, and you say to yourself, hey, look at that. Apple's down 36 cents. All right. So it was 98, actually 37 cents. If you I don't know what's up with their calculations, but they're off by a penny. Apple closed. See, this doesn't give me confidence. All right. Apple closed 98.36. It's down 36 cents today, and it closed 97.99. Explain that one to me. Last I checked, that's 37 cents.
Oh, it's a different day.
Yeah. So, I think it's probably just kind of the bid offer where things printed, just kind of the final print. They, whatever. I'm kidding. But so you've got the 97.5 puts that you buy for $2.15. You come in today, at the end of the day, you've been hard at work. You were off laying blacktop. All right. You're in the asphalt business during the day. All right. So you come in today and you look at your 97.5 puts and you say, what in the world? Apple's down 36 cents, and I lost 60 cents on my puts. That doesn't make any sense to me. All right? All right? Why did you lose? All right? You lost because, well, take a look here. All right? Yesterday, the volatility was 9 points higher. Take a look at this. I'm going to pull up a little graph that shows you what volatility does. Take a look at the volatility on the strike. Yesterday, the implied volatility of the strike was 37%. Today, the implied volatility of the strike is 27.75. All right? That is what changed. One of the fundamental things that really prices an option changed on you. That is why you lost money. Any questions on that? All right, good. All right, now, let's get down to delta now. All right, the Greeks, including delta, are priced by a pricing model. All right, they are based on modeled risk. All right, they are meant to help traders manage the risk of a given option position. All right, the Greeks are an output of a model, thus they're not a hard number. Anybody ever heard the term garbage in, garbage out? All right, so if I put a bunch of cruddy numbers into an analysis and I spit out something that I think is going to give me a favorable result, and then I don't get a favorable result, well, the problem is I put in a bunch of cruddy numbers. Real simple. All right, and so that is what happens with delta. So since delta can change and is modeled risk, what is garbage in, garbage out? Yeah. Oh, they say GIGO now. Remember that's or wouldn't it be hashtag GIGO if you were on Twitter? Sorry. So so the point is, since delta can change and it's a modeled risk, picking the right option for the directional opinion is key. Should an option be bought or sold, in the money, at the money, or out of the money? It all depends on one thing, and that's implied volatility. All right. So what makes trading a stock different than trading volatility? All right. Over the long term, we have a pretty good idea of where implied volatility is going to be of a stock or an index. All right. Now, an underlying stock price, we have no idea. The idea is IV implied vol mean reverts, underlyings do not. So here's Apple. All right. Do you see the mean? Not really. All right, it's off to the races right now. Now, what about this one? You know, this is a 2-year time frame. You can see there's been a little trend lower, and a little trend higher, but you can see it kind of does hover around an area. Volatility hovers in the near term and the long term. In the near term, it has certain ranges that it'll be within a volatility set. All right, and in the long term, those volatility sets revert to kind of a general volatility. Well, that's good to know. All right. Now, again, a stock price can go anywhere and stay there. Volatility can go anywhere, but it can't stay there. It will go back. So understanding this will help with those buy-sell decisions. All right. In general, when IV is low in the near term and in the long term, one wants to play direction, it makes sense to buy instead of sell options. All right. When IV is high or normal, it typically makes more sense to sell options or call or put spreads. For the retail trader, typically one is going to buy options outright and sell spreads. That's typically the way things end up, mostly for margining. All right, so getting long. When one wants to go long, one can sell puts or buy calls. Each trade acts very differently despite being long the underlying. All right, a short put is long delta and short vega. Vega is a market maker term for exposure to implied volatility. All right, so if you're long the underlying, what do you want to happen? The underlying to go higher. All right, if you're long volatility, what do you want? You want implied volatility to go higher. All right. Thus, a trader is hoping the stock moves higher and an implied vol comes in. Now, let's talk about what makes implied volatility drop. All right. What makes market perceptions of volatility, future volatility, drop? One, the market stops moving. All right, you look at the VIX. Why is the VIX 13, which I am telling you is too high? All right, because the market isn't doing anything. All right, if I pull up a chart of the market, let me take a look at realized volatility of the SPX. You know, I don't know why, but you know I played that Chicago song earlier in the day? During Option Pit Live, sometimes when things are a little slow, I'll run kind of my I'll simultaneously run kind of trading idea generation, and I'll kind of be a DJ.
Which is like in any trading thing.
It really is. Yeah, jokes, whatever's going on. So take a look at realized volatility. All right, in the S&P. All right, over the last 10 days, it's a whopping 4.5%. Less than 4.5%. Over the last 20, it's 5.2. Over the last 30, you get an astounding 9.3%. Now take a look at this. Now here's implied vol. Take a look at that. You explain that one to me. All right. Now I'm going to be watching this. This keeps creeping higher, and this keeps keeping lower. The systemic alarm bells are going to be going off, and I'm going to be backing up the truck on like some sort of backspread for a credit would be my thing, probably. But that is neither here nor there. All right. So really, a short put is actually a play on market moving stopping. market movement stopping, and really no major events. So when selling a put, what you're really betting is not that a stock's going to go up. So if you're selling credit spreads or naked puts or cash secured puts, what you're really betting is not that the underlying is going to rally. You're betting that the underlying is not going to drop. It's a huge difference. Remember, this was the part of this was the very first presentation you and I ever did. Yeah. No, in New York.
Holy gosh, that's right.
With the street.
That was pretty.
Oh, by the way, I've got Andrew Giovinazzi in town this week, and he's sitting next to me. So that's who I've been chatting up in the background a little bit. We've got a big trader summit this week, so he's been hanging out, kind of listening in and throwing in. Try clicking on the go-to meeting if you can't see the slides, but you should be able to. So here's IBM. All right, you can see the vol's rallying. Vol's nice and high, way over realized vol. All right. At the same time, the underlying really doesn't do much. Kind of just sits on that 200-day moving average, kind of bouncing. This was a great opportunity to sell like the 85-80 put spread. Worked out great. All right, now, a long call is long delta and long vega. All right, thus the trader's hoping that implied vol goes up and the underlying goes up. Geez, did that twice. 1 minute, I got to go back. Anytime I see that the underlying goes up and vol goes up. All right. So what's going to make that happen? An increase in movement, an increase in expected movement. All right. When you buy calls, you're betting that the underlying is going to go higher. It's straight up. All right. All right. Think about this. Selling puts is kind of like taking the points in a football game. If you're betting in Vegas, selling puts is a lot like taking the points and trying to cover the spread. All right. Whereas buying calls is like playing the outright money line. Does that make sense? What do you think about that? You think that's an apt analogy? Oh, I misspelled under. Oh, you're right, I did. Well, I'll fix that later. Yeah, it's underlying. I understand. So that's a pretty apt analogy, don't you think? Yeah. So that's really what it's like. All right. So here's one in NTAP, and this is one where vol just got absolutely just obliterated. And even though the underlying didn't really move that much, because we bought calls, it rallied hard enough that we were quickly able to take advantage of kind of a consistent, momentous rally. And vol held firm. You know, sometimes when buying calls, volatility, the underlying moving higher and volatility not dropping is 100% of victory when you buy calls. All right? I can tell you this. If you buy calls and the IV doesn't move and the underlying rallies, you're going to make a lot of money. All right, now getting short. Like getting long, when one is making buy-sell option decisions, you take implied vol into account. All right? When IV is high and one thinks the stock is going to go down, you sell calls or call spreads. When IV is low and one thinks the stock is going to fall, you buy puts. So here's a couple of examples. Here's a good short call to trade in SLV. See, vol got nice and juicy high. So you see, you get like a nice little pop here on this underlying drop. You sell calls. Underlying doesn't do anything. You know, at this whole time, look at this pop. All right. You sell the 21-23 call spread over and over and over again. You make a blasted killing. That was a great play. I mean, we were just like, sell the calls, sell calls, sell calls, sell calls, sell calls. We started to sound like the Energizer Bunny in terms of selling calls in SLV. Now here's one of buying puts. Now this was a while back. This was into these are, by the way, these are all trades pulled from our strategy letter. We were buying puts. This is one where we looked at kind of vol was real low, and we've got a Fed decision coming up, and we're leading into taper, and everyone's like, okay, why are they crushing implied vol and IYR into the Fed decision? So we went out and put on some long puts, and you can see we wrote them down. It was a nice little play. All right, now let's talk strike selection. All right, so once you figure out what you want to buy and what you want to sell, now you get into strike selection. All right, this is done based on the certainty of the next vol move. When one believes that IV is going to go up, all right, and you want to go long, you buy softer deltas. All right, when you want to go short, you go harder deltas. All right. When one believes that IV is going to be stable or going to go down, and you want to go long, you go hard deltas. When you want to go soft, when you want to go short, you go soft deltas. Real simple. All right. So what is a hard delta? I'm going to talk about them now. Softer. Softer is kind of like Chicago's transition from the late 70s to the mid 80s, when they went from kind of the big brass band into more doing the theme from Karate Kid Part 2. It's when Madonna went, well, not really Madonna. It's like when softer deltas are like when Guns N' Roses did Sweet Child of Mine. Kind of like that. Kidding. Seriously. No, a hard delta is going to be typically going to be in the money. A hard delta is going to typically be in the money, and in the money options are or closer to in the money, and hard deltas are going to be resistant to change in volatility. All right, so they're going to be your heavier deltas. So think a delta from kind of 65 to 100. Right, when you say 65 to 100 about a hard delta. Softer deltas are going to be kind of that 65 to 15. Okay, that delta. Now you're saying, Mark, what about like 15 to 0? Those are kind of their own thing. And really, if you're looking at trade options for direction, don't buy 15 delta options. All right? That is the quickest way to lose a bunch of money. All right? So soft deltas are dependent on change in volatility. Understanding the difference can help. So now let's look at a couple of examples. All right? When would one want to use a hard delta? All right? When one isn't sure of the future IV movement. All right? When implied vol is really high. All right? And you don't know where it's going to go. All right? When implied vol is really high and you think it's going to go down, hey, soft deltas, right? All right. But when IV is high and you're like, I have no idea what's going on, all right? When you're playing like pre-event stuff. So if you wanted to play Apple for the last week leading into the announcement today, hard deltas made a lot of sense. If you were playing straight direction. All right, if you're doing volatility bets, totally different discussion. All right, this is really a pure discussion on directional plays. All right, when one isn't sure the severity of the expected move, but wants to have limited risk. So here's Goldman, and this is look at how high the vol got, just crazy high. All right, and you're saying to yourself, all right, Goldman's bottoming out. All right. There's no way I don't think it's going higher. So I'm going to buy some, I'm going to look at 2 trades. Now in this case, I want to keep it simple. So all we're going to look at is buy-sell decisions for, am I going to buy a hard delta on the calls, or am I going to buy a soft delta on the calls? We're going to kind of skip the idea of selling puts, which in and of itself would have been a great idea. All right. So here's Goldman on 11:15. And you can see you could buy the 110 calls for $7.60, vol about 29%, or you could buy the 125 calls for 96 cents. And you can see how they moved. A couple days later, the 110 calls are 10.65, and the 125 calls are 119. Well, let's look at those in terms of a dollar allocation. All right. On 11:15, if you buy one 110 call, all right, you're spending $760 to buy 70 deltas. So that's a 0.7 correlation to the movement in Goldman over between now and expiration, theoretically. Alternatively, for 96 cents, you could have bought 8 of the Goldman Sachs 125 calls, and you'd spend $768. So you'd spend an extra $8, and theoretically you're buying 130 deltas. Well, now on 11/23, so 8 days later, Goldman's trading $5 higher. You can sell your 110 call that you bought for 10.65, or you bought for 10. You can sell that at 10.65, so you make a profit of $3.05. Or you can sell 8 of the Goldman Sachs 125 calls at 119. It's a profit of $1.84. You make $184 on 8 calls. So even though you bought more deltas and spent more money and bought more contracts, you make less money. Why? Well, let's go back to that volatility chart. If you're buying a bunch of out of the monies when you see, out of the money calls when you see vol like this, you're a fool. You're not a fool. You just don't know what you're doing. We honestly see this all the time. It's like, Mark, Andrew, why didn't I make money? You bought crazy, disgustingly high implied volatility out of the money. Don't buy soft deltas when vol's high. All right. So now a soft delta is more sensitive to implied vol. All right. So you buy them when vol's really low, when you're expecting a major move, and of course when you want to make kind of an inexpensive bet. So here's IBM, and this is one that we did that we were very pleased in. All right. So take a look at, at IBM. They just destroyed the implied volatility. And this is always, I'm always shocked by this. So let me get this straight. So over the last 3 months, Apple's dropped from $210 down to $185, and it's made multiple large gap moves. And you want to just plummet the implied vol. My response is always, go right ahead. I will buy them from you. Give me whatever you want. So we can buy the December 85 calls for $680, or we can buy the December 195 calls for $122. You can see a couple days later, the 23rd, I can sell my 85 calls at 930, or I can sell my 95 calls at 225. You can see the vol went up. So let's take a look at what happened. On the 21st, IBM closes 190.29. My 185 calls that I paid $680, I bought 75 deltas, spent $680. All right. I can buy 5 of the 195 calls, spend $610, I could pay $1.22, pick up 145 deltas. Well, let's look at what happens a couple days later. On my Dees 185s, I make a $2.50 profit, 250 bucks. Not bad, right? Not bad at all. Now on my 5 195 calls, so I spent less money and I make more than double the profit on my calls. Why? Because I was buying volatility in the floor. That is how you play soft deltas. And I promise you, this is something that we are on top of like hawks here. All right. The two things Andrew and I are really good at. One, analyzing volatility. Two, trading it. So now, here's my favorite combo. All right, so let's say you don't have live vol. All right, and lots of people don't. Now, Thinkorswim puts out vols, whatever. So the CBOE puts out VIX methodologies. They're really pretty great. There's a bunch of them. They put out the VIX, obviously. The NASDAQ VIX is VXN. You've got there's a VIX for Eurovol, so where they're pricing the euro versus dollar trade. There's ones for the treasuries, and there's one for individual equities. 5 major ones are VXAPL, which is Apple, VXIBM, VXGOG, VXGS, and VXAZN, which is Amazon. All right, so when you see a stock, one of those stocks, hit a 52-week high, all right, and at the same time, you see that VX index hit a 52-week low. Try buying an out-of-the-money call that's around a 30 delta. All right, here's a good example of Goldman Sachs. This is one from a month and a half ago. Goldman Sachs, volatility probably the lowest in the last 10 years. Andrew and I were like, you know what? Back up the truck on calls. This is going higher. I wrote about it on the street, did an option pit, did it across the board. Was a great play. All right, and if you have vol analytics, there's different places to go out and find vol rankers. I'm not going to go through all those. Go out, and when you find things that are stocks at multi-year highs and vols at multi-year lows, out-of-the-money calls are going to perform really well because everybody and their brother starts selling covered calls into it, and those calls get oversold. So in summary, volatility reverts. Implied volatility helps form positions. There are different types of delta from those positions. And you've got to check to see if the position is sensitive to hard or soft. So now, here's the special offer I'm going to give you guys. All right, the Option Pit Silver membership. All right, this is just the classroom. Does not come with our chat room. All right, normally we have it come with the chat room for 149 bucks. But this is just our silver membership. All right, just our special recorded classes. All right, what you're going to learn how to buy stocks when others are panicking. You're going to learn mastery of the working parts of an options price. All right, how to make market volatility work as a friend versus a foe, and you're going to learn how to match a goal to the right option position. All right, along with a bunch of other things. All right, and we normally sell it for 149 bucks. I'm going to give it to you guys for $17.25. All right, all you do is go to optionpit.com/17special. All right, I'm going to leave this offer out there until next Tuesday. So get this, go out and buy this. It's pretty awesome. It's a really good course. It's 9 45-minute videos that are going to really give you a ton of education. And like I always said, it's funny. Warren Buffett goes out there and blasts options as super dangerous, and then you know what he does? Goes out and trades a ton of them. Frickin' hypocrite. Is the course on the website? Yes, it's www. It's the silver course. All right, you go to optionpit.com/17 special. Yeah. So the course you download the videos, you keep them for life. All right, they're yours to keep. Yeah, it's actually a pretty good deal. It really is. So, any questions? Questions, comments, thoughts? So if I repull that poll, how many of you are gonna switch to Mark is super smart versus Mark doesn't live with me versus I don't want to live with him? What other services do you offer? Well, we have a chat room that we run all day. Yeah, I'm going to post a recording. We have a chat room that we run all day. We also offer the next step beyond silver basically moves into a lot of really teaching traders how to approach trading like a professional trader. And I'll have the recording posted tonight. I'll have the recording posted tonight and look for an email tomorrow telling you where to buy it. So I will have this out. So our gold class is basically a 12-part professional level course that is done that's modular. So will I get a DVD in the mail? You will not, although I have no problem if you want to burn this into a DVD. The gold course is done in modular course. There's a quiz. It's a 5-minute session, little quiz, 5-minute session, and then when you do about 10 of the sessions, there's a chapter quiz. On top of that, you get once a week, you get an hour with me or Andrew in the room where you can ask us anything you want, and you get 4 months of access to our chat room, which we charge, almost $250 a month to get access to. And the gold course is just $19.50. So think about that. I mean, it's you're getting pretty much an awesome education and $1,000 worth of chat room. So it's a really good deal. Additionally, we've got once you get beyond that, you get into kind of our small group mentoring and our one-on-one mentoring. And we do a lot of work with a lot of individuals. I've worked with ginormous hedge funds, registered investment advisories, professional traders. Yeah, I can tell you what goes on in the chat sessions. Generally speaking, I think the one thing that differentiates us is Andrew and I both consider ourselves traders first and educators second, and you will see that come out. So on the chat room, typically between Andrew and I, we're on during the 6.5-hour trading day. We'll be on for about 3.5 hours. So we do a quick 10-minute, here's what's going on in the day around 9:50 Eastern time. Then from 9:15 to 10 o'clock, 10:15, one of us will talk. Typically, Andrew does kind of some really big thematic things or talks about kind of what each of the VIX products are doing, then moves into kind of, getting some ideas for the strategy letter. Then I do a breakdown of all the trades going on in the market, where I'm seeing edge, kind of where, how I would be trading different order flow off of other order flow. Then around, and we'll typically be done around noon Eastern time. Then Andrew and I take a break. Starting at 1:30 Eastern time, we do what's called the pit report. And in that, we basically cover exactly what we see going on for the day. We cover exactly what we've got going on during the day. And then we'll cover what our strategy letter is doing. And then we'll add or subtract trades, make adjustments to our strategy letter. Finally, there's a market wrap-up from about 3:30 to 4. What software do you use? We typically trade in TD Ameritrade's Thinkorswim and Live Vol Execution. The 17 special does not have a monthly fee. If you want to get involved with the chat service, I'm happy to talk to you about that. You can email me info@optionpit.com or mark@optionpit.com is my direct email, and I'm happy if you want to give me a call. I answer the phone. It's 17 special, not 19 special. So it's http://www.optionpit.com/17 special. There is the link. What about the gold special you mentioned? The gold special, I'm going to, the gold special goes for $19.50. It comes with 4 months of our chat room included. So that's actually, in itself, its normal price. If you have interest in the gold course and you want to learn a lot about it, just shoot me an email, mark@optionpit.com, and I'll happily talk to you about it. We can set up a time to chit-chat. Whatever. If you sign up for, $19.50 is a deal. I think we're offering on the website at $1,500, which is pretty good. No, not $19.50. I mean $1,950. So $17.25, $1,950. So the gold course on the site you can get for $1,500. All right. So, that's a pretty good deal in and of itself. But if you've got interest and you want to hear more about it, feel free to give me a call or shoot me an email. There is a big difference. Well, that is a much more in-depth and intense course, and actually requires us to meet with you live an individual time on a weekly basis. What is LiveVol's website? www.livevol.com. And my students get special deals on LiveVol as well. But you have to be signed up for Option Pit Live or better. But yeah, I understand $1,500 is a lot, but you get a ton out of it. And honestly, for what we charge $1,500, you go to another option guy, he's going to try and sell you something inferior for what, $6,000? I mean, it's crazy what some of these guys charge. I mean, it's just mind-blowing.
It's 12 hours of live instruction.
Yeah, exactly. It's 12 hours of live instruction a week, plus a ridiculously good, put together course. Andrew, my partner, built the training program that everybody at Group 1, including myself, learned how to trade on. I mean, Andrew taught the guy that taught me how to trade. And then since then, I've taught hundreds of people to trade, and so has Andrew. So you're dealing with some of the best people in the world here. At least that's what my mom tells me. Yeah, my wife tells me my wife definitely tells me that when I bought her a new pair of shoes. Or when I bought her a puppy. Thanks, Haley. All right, any other questions? Great. I will have an email out with a replay of the webinar tomorrow. I'm actually going to post a replay of this. LiveVol better than Toss. Yeah, probably. But different. I think that there's, in terms of straight options, yes. But if you're going to trade futures and a bunch of other stuff, I actually have accounts with both on purpose. And almost all of my LiveVol guys also have a Toss account. So that would be my answer. I think the two go hand in hand because the areas where LiveVol is a little weak, Toss picks up. And the areas where Toss is a little weak, LiveVol takes care of. Well, good. I really am glad that you guys found this useful. And, I go out and do my best to provide you guys something that's worth your time. So I really appreciate your guys' time and hope you have a great night. See you guys all soon. Hopefully I'll see you all buying on this $17 silver course.